This is 1031 Exchanges Essential Concepts. Let me get my mouse. Here we go. So my name's Dave Tornell. I'm the Commercial Sales Manager at Chicago Title, Arizona here. Work along with Eric Wolf, who's my counterpart, and Lindsay Sanchez. She's our marketing guru that's helping us out on this deal here. Prior to that, I spent, I think, 13 years at IPX 1031, and that's all I did, 1031 exchanges. I'm a certified exchange specialist through the Federation of Exchange Accommodators, and that kind of is about it when it comes to that. So what are we going to talk about today? We're going to look at why investors want to do 1031 exchanges. We will look at the tax reasons. We'll also look at the non-tax reasons. We'll get into the rules. There are some rules that we have to follow when we're doing 1031 exchanges, the statutory requirements that we'll talk about there. We'll talk about delayed exchanges, which is the timelines that everybody wants to know about. Maybe a little refresher for some of you. So with that, 1031s, they are not anything to be afraid of. They are literally two simple vanilla real estate transactions where we have an exchanger or an investor who owns investment real estate. They're looking to sell investment real estate. Sometimes this is called the relinquished property to a buyer. Just like any other regular real estate transaction, we have a seller and a buyer. At close of escrow, cash is transferred to what's known as a qualified intermediary. The investor then basically goes out and finds replacement property and purchases it from a seller. And at that point, that property is given back to the buyer, the exchanger, and that completes the 1031 exchange. So not a whole lot different. We have a seller and a buyer on one side and a buyer and a seller on the other. And really what happens in the middle here between the exchanger and the QI is left up to them and their tax advisors. For the broker or the agent out there, it's business as usual. And there's a couple additional things you might have to add to the contract, but we'll talk about that a little bit later. So, a little background of Section 1031. They are not new. The actual code section was enacted in 1954, but exchanges have been around since, I believe, early 20s. And they gained greater use in real estate after the Tax Reform Act of 1986. Now, if you don't know your history, basically what happened in '86 was capital gain tax rates went through the roof. And so a lot of individuals started using this section of the tax code. Now, because of the fact that most of us don't like to, play with the IRS, if you would, at the time, there was no real guidance on 1031. So what you had was a bunch of, aggressive investors and their tax advisors kind of using 1031 and taking advantage of it. Well, in 1991, the IRS wanted all taxpayers to take advantage of this, and so they basically enacted regulations or guidelines, if you would, in 1991. And with that, they introduced this entity known as the qualified intermediary. They gave us, or they established clear rules on timelines and a lot of other things, but basically that's the short history of 1031. Recently, with the Tax Cut and Jobs Act in December of 2017, there was a push to remove 1031 from the actual tax code. That did not happen. They kept most of the 1031 section of the tax code. What they did eliminate was the elimination of personal property exchanges. Used to be able to exchange planes and jets and basically any personal property that was depreciated for investment or business purposes. So they did away with that. But we still can do 1031 exchanges on real property. So one of the recent notices, and this is the IRS Notice 2023 that just was issued here, I don't know, a week or so ago. basically gave extensions for clients in a 1031 exchange. So this is a little bit different from a usual disaster extension that provides for an extra 120 days. For instance, like if there was a hurricane, generally the IRS issues a disaster extension that extends the time period for the investor 120 days. But the one here is a little bit different. Here are two examples we can look at. Example one, so if your exchange began April 1st, 2020, your 45th day is May 16th, which would be extended to July 15th. So they're extending your identification period if you start an exchange after April 1st. The taxpayer must still close on the replacement property by September 28th, which would be their normal 180th day, because September 28th is after the disaster period of July 15th. So they're not going to get an extension on their time period of 180 days, but they would get an extension on their identification period. In our second example, the exchange began December 31st. Their 45th day was February 14th. So their identification period wouldn't have been extended, but their 180th day is June 28th, which would be extended until July 15th, 2020. So those are the two examples that kind of work the scenarios that hopefully most investors will fall into. They are actually, there's another letter to the IRS to hopefully bring the time period back to January 1 of 2020, but we'll see what happens with that. But this is what we currently have right now. And you can look this up. It's under IRS Notice 2023 and read the whole thing if you want. So with that, let's look at Section 1031. Section 1031 is one sentence. No gain or loss shall be recognized in the exchange of property held for the productive use in a trade or business or for investment if such property is exchanged solely for property of like kind which is to be held either for the productive use in a trade or business or for investment. So what does that sentence mean? Well, simply put, if you own investment real estate and you know you want to sell it and go buy more investment real estate, well then you can take advantage of 1031 and defer your taxes. Now within that sentence, we have these highlighted red words here. And those words are statutory requirements. These are the rules that we must follow in order to have a qualifying 1031 exchange. The property must be held for productive use in a trade or business. It has to be an exchange. The investor has to sell real estate and purchase real estate. And then the final one is that like-kind requirement that states that the property you're purchasing must be like-kind to the property you're selling. Now, we're going to talk a little bit more about those in depth later, but the basic gist of 1031 is if you own investment real estate, you can sell it and do a 1031, defer your taxes, and go buy more investment real estate. So in real estate, though, we have a couple different property types. There's only three, really. The first would be a primary residence. Most of us have those. Or you're hoping to buy one. And for primary residences, when we sell investment real estate, or I should say primary residences, it falls under Section 121. Most of us might have heard of this. It's the 2 out of 5 rule. If you've lived in your primary residence 2 out of the last 5 years, if you're a single filer, you can take up to $250,000 of gain. If you're married filing jointly, you can take up to $500,000 in gain. Second type of property we have would be second homes and vacation homes. Unfortunately, these do not qualify for 1031. You would have to pay taxes upon the sale. You can convert second homes to vacation homes simply by renting them and changing how you file them on your taxes. So that is a possibility, and that might be another webinar we'll talk about, or some we can talk about later if you guys have questions on that. Our final type of property would be investment property, and that kind of consumes everything else that's out there. And for that, we have Section 120 or 1031. So under 1031, the gain is deferred until the sale of the replacement property. So sometimes these are called tax-free exchanges. They are not tax-free. The only way to be tax-free is if you die. Not the most sought after estate planning method, but that is basically the only way to be tax-free, With 1031, they are deferred until the sale, or deferred until you cash out of the replacement property. So when we sell investment real estate, we have three choices. We can sell and pay our taxes, and right now, if you add a federal and state, and again, this is dependent upon which state you are in. Your state and federal could be anywhere, topping out around 30%. So we've got state and federal. So our three choices when we're selling investment real estate are sell and pay our taxes, sell and take a note back. If you own that property free and clear, you can do a carryback note to your buyer and, spread that gain out over the length of the note. You're only going to pay taxes on, if it's a 10-year note, you'll spread your taxes out over that 10-year time period. So that's another option. And then our final option is to do a 1031 exchange, where again, we defer our taxes. So when we're doing 1031 exchanges, we are transferring what's known as the basis. And if you don't know what the basis is, it's basically the original purchase price plus improvements minus the accumulated depreciation. And whatever that number is, that's the number you are going to subtract from your net sales price to get your capital gains, because of the fact that taxes are paid on the difference between the sales price and the basis of the property, not on the equity. They're two separate calculations. So there may be taxes owed even if the property has no equity, basically. So got to look at that. Now, calculation of tax basis, like I stated, we take the original purchase price plus capital improvements minus the accumulated depreciation, and that will give us our adjusted tax basis. Now, again, we pay tax on the difference. So if we give you an example here, we bought a property for 200 grand, we put 25,000 of improvements. Over the time that we've owned it, we've taken $10,000 in depreciation deductions, and that will give us a tax basis of 215,000. Well, if we sell that property for 300 grand, and this is again not taking into consideration any closing costs, what is the capital gain? Well, the capital gain would be 300 grand minus 215 gives us a capital gain of $85,000. So that is how we figure out our capital gain. Now, when we're doing 1031 exchanges, there's this thing called basis transfer. And so say I own a condo up in Colorado and I want to sell it and go purchase a property down in Texas. So my condo in Colorado is worth 200 grand. Again, the townhouse I want to purchase is also $200,000. The basis in that property is 100,000, and the basis in the replacement property, if I sell it, well, I have a $100,000 capital gain here, 200 grand minus my tax basis. I do a 1031, and I still will have a $100,000 capital gain because I'm basically just transferring that basis over to the next property. Again, what the IRS wants to see when we're doing 1031 is a continuation of the investment. The asset changed, but my tax liability didn't change. Now, say we do that same exchange. There's that 100,000 in gain. We go to the townhouse in Texas, but this time, let's say that townhouse in Texas is 300,000. Again, I'm going to subtract my gain from this purchase price of 100 grand. So my new basis would be 200,000. Again, I have a $100,000 split. I had a $100,000 capital gain here. I still have that $100,000 capital gain. I hold on to this property for a couple of years. I end up selling it for $350,000. So I now have a capital gain of $150,000. And I go buy, say, a commercial property for 400 grand. And again, taking that 150 minus the 400 gives me a basis of $250,000. So that is basically what happens in a 1031 exchange is we keep transferring that basis from property to property as we go. Now, the number one reason why investors do 1031 is to preserve their equity. And here's an example. So say I own an investment property worth $1 million. And what I want to do is I want to sell that property and purchase 3 other investment properties. Now, I hire a broker, and unfortunately, they don't say anything to me about a 1031 exchange. And so, come tax time, I'm going to have to pay taxes. Well, I don't do a 1031 because I don't know about it. Maybe I'm not that sophisticated. And Lindsay probably got that on tape, me saying I'm not that sophisticated. Thank you. But now I have my $1 million property that I sold, and come tax time, I go to my CPA and say, hey, I sold that property. What's my tax bill going to be? And he's like, well, you had virtually a zero basis in that property, so you've got $1 million in capital gain. And he goes, your tax bill is 30%. Your tax rate is at 30%. So 30% of $1 million is 300 grand. So I get my checkbook out and I write that check off to Uncle Sam for $300,000. Now, unfortunately, that's 300 grand that I'm never going to see again. It's never going to grow for me. It's never going to, do anything for me. Now, I still have $700,000 left over. And so I use that 700 grand as 25% down, and I can purchase $2.8 million worth of real estate. That is selling and paying the tax, unfortunately. Now, second scenario, same scenario, except this time my broker tells me about a 1031. I actually get to keep all of my equity because we're deferring those taxes. And now I've got $1 million in equity to use this 25% down. Well, and now I can, with financing, obviously purchase $4 million worth of real estate. So that is, again, the biggest reason why investors want to do 1031 exchanges. It is because of the fact that it preserves that equity instead of carving off that 25% and throwing it away. If we look at two investors, one investor, and we look at their investment career, we have one investor that sells and pays their taxes versus the investor that does 1031. We put it out over a 10 to 15 year investment career. The investor that does 1031 will have almost double the assets just because of the fact they're not carving off that 25 to 30% every time they sell. So again, preservation of equity is the biggest reason why we do 1031. Now, obviously this is just what I stated. There we go. Let's go to the next slide here. So looking at taxes in a sale, if you sell a property, you have to pay the tax. That's for a capital gain. If you sell a property for a gain, you have to pay tax. It's out of Section 1001. That is pretty basic tax law. In a taxable sale, recognized gain equals, again, our net sales price, so we're carving out closing costs, all that stuff, minus our tax basis. And again, that's going to give us our capital gain. So 2020 capital gain tax rates are here as follows. And so if you are single filer, your top rate would be 441, 450 until it bumps to this 20% rate. If you're married filing jointly, it goes to 496.6, and you can look at the other married filing separately, head of household, all that other stuff. The 496.6, we're going to be using in the example coming up here, but those are the capital gains tax rates for this year. Now, looking at our tax rates, with capital gain tax rates, they stack. So if you fall, meaning that the tax rate is progressive. So if you have a mix of capital gain, a portion of it might be taxed at 15% and a portion may be taxed at 20%. So in the example here, we have a married taxpayer that has $400,000 of taxable income, and they have 200 grand of long-term capital gain. Well, the 499.6 of long-term capital gain is taxed at 50%, and the leftover 103,000 is taxed at 20%. So the capital gain taxes will stack dependent upon if you pierce that threshold under the capital gain taxes limits. Looking at our taxes, if we sell, we're looking at anywhere between 15 and 20% for federal taxes. Additional taxes are state taxes, and again, it ranges anywhere from 0 to 13.3%. I believe there's 8 or 9 states out there with 0 state tax, and our friends out in California are at 13.3. And I've heard they might be increasing that, but we'll see. More people moving to Arizona. Additional tax would be depreciation recapture. One of the benefits of owning investment real estate is that you get to depreciate it, but when you do sell the property, you have to pay back 25 cents for every dollar in depreciation that you've taken. We also have on certain investment income, and this is the Affordable Health Care Act tax or Obamacare tax. There's a lot of names for it, but they tax you on certain investment income at 3.8%. So looking at our example, we have a married couple filing jointly, and they've owned an office building for 10 years and they want to sell that property for $3 million. They originally paid 1.5 for the property, put $200,000 of capital improvements into the property, and over the time that they've owned it, they've taken $600,000 in depreciation deductions. The exchanger owes $2 million to the lender. So we're just going to kind of walk through the taxes on this. So if we look at the basis, our original purchase price is 1.5. We put 200 of improvements into it. Less our depreciation of 600 grand gives us a basis of $1.1 million. So calculating out our capital gain, we're selling for $3 million, less those closing costs, gives us a net of 2.8. We're going to subtract off our basis of 1.1, gives us a capital gain of 1.7 million. Well, let's go see what the tax bill is going to be on this. So our federal capital gain, 1.7. Gain due to depreciation is 600 grand. At 25% is $150,000. We always take our depreciation first. Leaves us with gain due to appreciation, the property actually increasing in value. And again, this is going to be split here. So the first 496.6 is at 15%. That's 74,490, and the remaining 603 is taxed at 20 for 126.80. We have a total of 1.450 investment income at 3.8%. So that's 55,100. The threshold on that is, I believe it's 150,000. That would make sense. I'd have to double check that. So our state tax, we put it back together at 1.7 at 5%, just to put a random 5% in there. Arizona's actually right around there, maybe a little bit lower at 85,000. So our total tax bill, if we were to sell this investment piece of real estate, is $485,270. Yeah, I was incorrect. The Affordable Care Act tax is 250 grand. So that is a number that I suggest to everybody I talk to if they're an investor and they're looking at selling their property and they're looking at 1031ing, I always ask them, hey, do you know what the tax bill is? Because a lot of investors will look at this number and say, you know, that's $500,000. We can go buy another piece of investment real estate with just that $500,000. Other investors, they might just say, oh, it's only $500,000. Let's pay the tax and get out. Taxes are low right now. But again, you got to know this number to make an educated decision. Now, looking at if we do a 1031, we get to keep all of our equity, right? $800,000. We use that as 25% down. We can buy $3.2 million worth of real estate. If I end up paying my taxes of that $485,000, I'll be left with $314,730 to reinvest. We use that as 25% down. We can buy a little over $1.25 million worth of real estate. Again, we can buy almost 2.5 times the value of property without adding any cash there. And at a 5% return, this will generate additional income of almost 100 grand a year. So again, going back to that preservation of equity example, this is the biggest reason why investors want to do 1031. Now, looking at some non-tax reasons why investors do 1031, let's talk about land for a second here. What is the investment strategy with land? Is there one? So a lot of people may wonder, but the reality is you know, there's no income unless you're leasing the property. Maybe there's a little bit there, but you can't depreciate land, so there's no benefit there. Generally, the strategy with land is to buy it, hold it, and hope it appreciates. Now, one of the biggest misconceptions in 1031 is this definition of like kind. A lot of investors feel that or maybe they don't know about 1031 or they're just too strict with their definition, but a lot of investors think that if I own investment land, if I do a 1031 exchange, I got to go buy like kind property, and that means I got to go buy land. Well, that isn't the case. Under 1031, we can actually exchange into an improved commercial property. This is a really big piece of land to go buy this building. But the reality is they are like kind. If we go back to the code section, it says any property held for investment or used in a business. And as long as these are two properties are held for investment or used in a business, they are like kind. So with this land, again, it doesn't generate any cash flow, and I can't depreciate it. I could actually sell that land and move it into, let's just say we go buy a commercial strip center, and now with my commercial strip center, I have a monthly cash flow. I now have a depreciation deduction, generally greater appreciation because improved properties generally appreciate faster than bare land. And again, it's all done through a 1031 exchange. And now, other non-tax reasons, reduce operating expenses. If you do have a property that's a little bit older and it's has high operating costs, we could sell that 1031 into a newer property, hopefully lower those operating expenses. We can increase an individual's net worth. In this example, we're just using small numbers. Let's say we bought a $200,000 residential investment rental. We own it free and clear, so no debt on it. We could actually sell this property, do a 1031 exchange, go put $100,000 on two $200,000 properties. And so instead of one property generating income, I now have two investment pieces of real estate generating income for me at 50% loan to value. And again, we increase our net worth through leverage. We can increase appreciation potential. Again, moving across the street or across the country to better markets, hopefully timing the markets. We saw this back in the early 2000s. It started in California, went to Vegas, came here, and investors were just moving their assets from one place to the next to get that appreciation wave. Reducing risk. If you have assets in the Gulf states or Florida and you're tired of getting hit by hurricanes, again, we can move into places like Arizona where we don't have much of anything. Less management intensive property. Again, we can move from, let's say we have a portfolio of residential rentals, and a lot of investors that own multiple residential rentals are talk about the terrible T's, the tenants, trash, toilets, turnover, all that stuff, and they don't want to deal with it anymore. They could actually move it into a triple net lease type of investment, a Walgreens or something like that, where basically it is mailbox management. We can do that as well. That's kind of an example of consolidation, where we have multiple assets and we can move them into a commercial property. We also can go the other way. If we want to diversify, if we have one large asset, say out in Southern California, and we want to move it and diversify our assets across the country, we can do that. We can do it in, obviously, the continental United States and a couple of U.S. territories. That's where Ron's at, in U.S. Virgin Islands right now, looks like. So, all right, we can move from co-owned property to exclusive ownership. So say my sister and I own an asset together. We're not a partnership. We own this property as tenants in common, and each of us, we decide we want to go our separate ways. We each own that asset and report the portion of that property on our own separate taxes. And so we decide to go our separate ways. Well, each of us can do a 1031 exchange and go into 100% ownership of the new asset. Or if one of us wants to cash out, one of us will cash out, the other can defer their taxes. Obviously, the individual that cashes out will pay their taxes. So relocate investment, we can move it across the street or across the country. An exchange for a property that may be easier to sell in the future. Exchange for a property to be used in your business. Again, anything held for investment or used in a business qualifies. So, you know, a lot of doctors or attorneys that maybe own some rental investment property, they could move it into a office suite or an office complex where they, you know, office out of one of the suites and rent the rest out. So tons of options under 1031. All right, the rules are basic statutory requirements, and we've got three. Again, the exchange requirement, qualified use, and like kind are our three statutory requirements. Now, the first one, the exchange requirement, again, exchange is just the act of substituting one thing in return for another. And that's what must happen in a 1031 exchange. The investor must give up real estate and receive real estate. Now, this can be accomplished by a direct trade or a swap, and this is kind of the old school way that they did 1031s prior to having a qualified intermediary. And say I own a piece of land, and I have another individual that I know that owns a piece of land, and I want their land, they want my land. Well, we could do a deed swap. I hand them my deed, they hand me theirs, and we go our separate ways. And that would be a qualifying 1031 exchange. But the issue with that is it's like a needle in a haystack, because of the fact that you've got to find somebody that wants your property as well as you want theirs, and you actually have to run into each other. So, you know, that's a challenge, and that's why, you know, you can still do these types of transactions today, but again, not very common. The majority of our transactions that we do are with this entity known as a qualified intermediary, and it is satisfied by the document known as the exchange agreement. Now, the exchange agreement is just the legal documentation that's put in place between the qualified intermediary and the investor. Now, looking at this document, we have the investor up here who's selling investment real estate. Now, prior to close of escrow, the investor and the qualified intermediary would enter into the exchange agreement. And again, probably the most important thing on this webinar is that an exchange has to be set up prior to the close of escrow on the sale of the relinquished property. Every once in a while, we get clients that, you know, close on their assets and they're like, oh, hey, I want to do a 1031. Well, at that point, it's too late because of the fact that they've closed escrow. They have what's known as, even if the money's sitting in escrow still, they have what's known as constructive receipt, meaning they have control over that cash. And when they have control, that triggers a taxable event. And again, that exchange agreement is the instrument that it insulates from doing that. And again, it has to be set up prior to close of escrow. Now, once that agreement is in place, what it does is it allows the QI to assign into the contracts on each side of the transaction. And so once that's in place, what that document does is it allows the investor to transfer their title or their property to the QI. And we actually used to deed in and deed out, but they don't do that anymore. It's done through direct deeding, and basically they transfer their property to the QI. The QI, through the exchange agreement, sells it to the buyer in return for cash. Now, the investor has given up real estate, right? Now the cash is sold, we close escrow, they pay off the loans, they do this, the equity comes into the exchange account. The QI holds that equity until they're directed by the investor on the property that they want to purchase. Once they find that replacement property, they tell the QI to send this property over, the cash over to the seller, escrow on the replacement side, QI transfer the cash to escrow, and then that property is deeded back to the investor, again, through via direct deeding. And that completes the transaction. But again, let me go back here one. That whole transaction works because the exchange agreement. And without it, you don't have an exchange, you have a taxable event. And again, it must be set up prior to close of escrow. All right. So this is just driving the nail a little bit further down. Set that thing up prior to close of escrow. All right. Next statutory requirement would be the qualified use. Again, the only properties that qualify for 1031 are in properties held for investment or used in a business. Now, easier to identify what properties do not qualify because there are just so many properties that do qualify for 1031. But properties that do not qualify are any properties held primarily for sale. This is considered to be inventory by the IRS. Now, what the IRS looks at, and when I say look at, when the IRS looks at you, the only time they look at you is when you get audited. And so, unfortunately, when you get audited, you are not innocent until proven guilty. The burden lies on you to prove your innocence. It's the other way around, right? Unfortunately. So, for instance, an investor that does fix and flips, what is their intent? Doesn't matter if it's a residential rental or commercial property. Their intent is to sell that property. They want to buy it, improve it, and then turn it real quick. And so that's what the IRS will look at, looking at their intent and their actions. Did they acquire to sell it or have it for a long-term hold? Now, long-term hold, a lot of investors, well, I always ask the question, how long do you think you have to hold investment real estate in order for it to qualify? And a lot of investors or tax advisors might even say at least a year and a day. And the reality is the fact that the IRS has not come out and said, X number of days qualifies a property as investment real estate. A lot of investors, or I should say tax advisors or CPAs, might tell their clients a year and a day for two reasons. One, to get you into long-term capital gain tax rates as opposed to ordinary income. If you hold a property for a year and a day, you're going to be taxed at 15 or 20% versus your ordinary income tax rates. Secondly, it gets that property into two separate tax filing years, because if I buy it in, June of 2020 and I sell it, a year and a day later, that's going to be in a different tax filing years. It'll hide the transaction, if you would. It's not going to be put on the same tax form. They're also going to look at how many improvements were put into the property. Other factors they're going to look at the profession of the investor. If you're a fix and flipper, or if you're a builder or developer, that could go against you. You're trying to build a case here in the event you did get audited, you would need to defend your position. They're also going to look at how many transactions they perform a year. So again, not dealer property. Now, I will say this, a lot of people might ask the question, how long do you have to hold, or what's the minimum? And again, it's really dependent upon your case. I had a client once who bought a piece of land up in northern Arizona, and they owned it, I think it was probably 3 or 4 months, and they got an unsolicited offer from a developer, a home developer or builder out of Vegas, and they wanted to buy that property for a significant amount more. I think it was like $500,000 more, and they'd only own it for 3 months. I asked them a couple questions. I said, hey, did you ever put any improvements in the property? The answer was no. Obviously, it only held it for a short time period. I asked them, did they ever put a sign on the property listing it for sale? They said no. Did they ever hire a broker to list that property? They said no. And they had an unsolicited offer. And I said, well, it's not up to me, but it's up to your tax advisor, but you have a pretty good case to defend your position if your 1031 got audited. And they went ahead and did the 1031 only after owning the property for 3 months. So it's really dependent upon your case that you would have to defend if you got audited. All right. Looking at other properties that do not qualify, obviously primary residence or second homes, we talked about those a little bit. They do not qualify for 1031. Now, if you do own a second home or vacation home or an investment property that you rent, you can use that personal property for 14 days or 10% of the rental period, all right? That is the minimum or that should say that's the maximum amount that the IRS allows you to use that property personally without it jeopardizing its investment status. It's 14 days a year or 10% of rental period. So if you rent that 300 days a year, you could use 30 personally. And again, that's the maximum. Now, every once in a while, you know, I get a person in one of my classes that says, well, how are they going to know? Well, the IRS has very long tentacles, and there was a student in one of my classes that I taught, and they had a second home that they, quote, 1031 into, but they never rented it, never intended to rent it. But, you know, they felt that they had gotten away with, you know, doing 1031 into a personal use property. But they did get audited, and the IRS subpoenaed their neighbors and asked their neighbors how often they saw them up there, and their neighbors were like, oh, we see them every day, or every other weekend, I should say. So they're up there all the time. All right. So conversions. Let me check something here real quick. Okay. If you do want to convert investment property, can you guys hear me okay? Okay, good. I just got a note there. So you can convert properties if you do have a second home or even a primary residence. You can convert properties from personal use to investment use and vice versa. You basically need to just change how you file them on your taxes. You know, generally, you know, if you do have a primary residence or a second home, you're going to be putting that on Schedule A and taking an interest deduction. Whereas if it is investment property, you're going to be depreciating the asset, maybe filing a Schedule C, and showing rents and things of that nature. So you can convert those properties. All right. So our last statutory requirement is a Likekind Requirement. Again, we talked a little bit about this. It's very, very broad. Again, we can these, you know, the farm and this building are like-kind, and again, very, very broad when it comes to the definition. And here's a list. It's not obviously a list in its entirety, but land, commercial buildings, stores, offices, warehouses, ranches, farms, rental homes, apartments, tenancy and common interest, easements, perpetual water rights on real property under state law. That also includes oil and gas and mineral rights. They qualify for 1031. Leases of 30 years or more, including options, condos, and timberland are all considered to be like-kind. So a very, very broad list that, you know, that is available out there. Now, property that doesn't qualify for 1031, again, property held primarily for sale, stocks, bonds, or notes, securities, or other evidence of indebtedness. A partnership interest, you cannot do a 1031 exchange out of a partnership for your partnership interest. Chosen action, right to collect debt, and last but not least, foreign property for U.S. property or vice versa. And again, we have to go U.S. to U.S., and that again includes some of the U.S. territories. I believe it's U.S. Virgin Islands, Guam, and the Northern Mariana Islands, but no Puerto Rico, unfortunately. All right, so delayed exchanges. Let's talk about the timelines real quick. So when we're doing a 1031 exchange, the investor has 180 days. Now, that clock starts ticking at close of escrow on the sale of the relinquished property, right? And so from close of escrow, that first 45 days is known as the identification period. This is the time in which the investor has to identify to the qualified intermediary what properties they're going to try and purchase within the remaining 135 days, and that is known as the completion period. The total is 180 days. So it's 45 and 135. The total is 180 days. Oh, and just a little bit of trivia. Today is April 15th. It's tax day. I haven't filed my taxes yet because we got an extension till July 15th. So I'm a little bit happy about that. Anyway, so it does say, which brings up, or tax filing deadline. That kind of was a little reminder there. So let's just say that we start a 1031 exchange on the last day of the year, right? December 31st. And so if we go out, I think I messed this up here. 45 days. I can't, I'm not going to talk about that one. So anyway, I got messed up when I started talking about today's April 15th, but anyway, let's talk, okay, I got it here. October 18th, let's say we start a 1031 on October 18th. Well, on October 18th, that gives us 180 days till April 15th, right? So if we count on the calendar from October 18th, that gives us 180 days, right? Well, on October 19th, how many days do we have till April 15th? On a regular tax filing years, we would have 179. And October 20th, we have 178, and so on and so forth. If we get to day 180, we actually have 135 days until our tax filing deadline, so we don't get the full time period. So the issue with this is if, you know, an investor, we get our W-2s the end of January, we're supposed to, and they go, hey, I'm gonna get 20 grand back or whatever it is, and they say, I'm gonna file my taxes early. So they file their taxes prior to that April 15th deadline, or prior to their, more importantly, their 1031 expiring. As soon as they file their taxes, it ends their 1031 on a long time, the tax implications for the sale of their relinquished property. So again, when we're between that time period of October 18th and the end of the year, if you started a 1031 between that time period, make sure you finish your 1031 before filing your taxes. All right. So identification requirements. When we're identifying properties through the QI, there's a couple of rules. Has to be in writing, has to be signed by the exchanger, has to unambiguously identify the replacement property, and it has to be delivered to a qualified person. Usually that's the qualified intermediary. And again, the identification has to be sent to the QI by midnight of day 45. Now, there are a couple rules under identification. There are two rules. There's the 3 property rule, which allows us to identify any 3 properties, doesn't matter what the values are. And then we have the 200% rule. And the 200% rule, you can identify any number of properties as long as the total does not exceed 2 times the value of what you're selling. So if I'm selling a $10 million property, I could identify up to $20 million worth of real estate. And that could be, you know, obviously if I was using the 200% rule, I'd be wanting to acquire more than 3 properties. So if 20 million identification, I could identify, you know, as many properties as I wanted to, up to 20 million, or 2 times the value of what I would be selling. All right. So practical suggestions, obviously, 45 and 180 day time deadline start and end with transfers, not contracts. So we can go out and get properties under contract. But again, as soon as escrow closes, that starts the clock ticking. If you can, you know, be well planned out enough, and, you know, close within that replacement period, and try to complete all that due diligence within that identification period. Now, one last thing on our identifications. Now, once we identify properties, we can revoke identifications and substitute them for new identifications as long as we're in our 45-day identification period. So if you identify a property to the QI and you're doing your due diligence and you find out, you know, hey, I don't like this property, you find some issues with it, you could revoke that identification and resubmit another property. But once we hit midnight, day 45, whatever you have identified, you are locked into. Okay, and those are the only properties you can use the exchange funds to purchase within the remaining 180-day period. All right. So with that kind of brings us to the end of this webinar. Do we have any questions? And Lindsay, I don't know if you want to open up audio, if you could do that.
Yeah, everyone can unmute themselves if they'd like.
Okay.
It's the bottom left button that says mute. But it looks like we have a question from Rob in the group chat.
You haven't
Okay.
talked about the cost of the intermediary.
I'm sorry, what was that?
The cost to have the qualified intermediary.
Yeah, cost generally will range anywhere, probably for a regular 1031 exchange, around $1,000 for, selling one property and purchasing one property. Some QIs might bump that up depending upon the price of the property. And there's certain thresholds that they'll, might be $1,500 if it's over, 5 million or something like that. But generally for a regular 1031 exchange, most QIs are around that $1,000 mark. And that is again for selling one property and purchasing one property. If you're going to buy additional properties, they might have a additional property fee of around $200, $250. It just depends on the QI. We didn't talk about reverse exchanges. Maybe we'll have another webinar on more advanced transactions, but if we are doing reverse exchanges, they are quite a bit more money. They'll generally start around probably 4,000 to 5,000, but there's a lot of other moving parts in that. But again, regular 1031 exchanges, forward exchanges are right around $1,000 generally.
Thank you.
My chat, where is it? Oh, here we go. Okay, so I have a question from Robert. It says, I have a question on a conversion from individual to the business where the individual owner of that business, will that qualify or will it have to be in the same name? So any individual, single member LLC, if it is a single member LLC, it doesn't matter if it's in the name when we're doing a transaction or if it's in the LLC name, because of the fact that single member LLCs are disregarded for federal tax purposes. So what the IRS, or I should say federal tax, looks at is, they look at the taxpayer. So as long as it's the same taxpayer on each side of the transaction, you should be good. Zach Price, he asked, can you touch on reverse exchanges? I could touch on them. I just real quick. The reality is that when we're doing a reverse exchange, you're buying the replacement before you sell the relinquished. And two things have to happen. One, you either have to have the cash to acquire, or basically to acquire the replacement property. As far as the mechanics of it, that cash is given to a QI who acquires the property for you. They hold it for 180 days. And once your property sells, then they make all the transfers. That is a little bit easier said than to understand, I should say, but I probably would be better off illustrating it later. But if you want, give me a call. We can talk about reverses in a little bit more in depth if you want. Any other questions? I don't see any other questions here. Then I will just end with this. Process for a 1031. 4 things to remember. Find a buyer for your client's investment property. Get that agreement under contract. Put the contract in escrow with Chicago Title because we have a great team out there. Have your client contact a qualified intermediary to set up the exchange. Again, don't wait until the 11th hour. And with that, that concludes our presentation on 1031 exchanges. Again, if you have questions, feel free to give me a call. Any of those numbers right there work, or you can email me at dave.tornell@ctt.com. We can just chat a little bit more in depth about any of those topics that you want. And again, if you have any research requests or anything like that, we can help you as well. So with that, thank you for coming. Thank you for attending. I hope you enjoyed it.
Thank you, Dave.
All right. Thanks, Lindsay. Thanks.
Thank you very much. Bye-bye.
Bye-bye.